Welcome to Wise Tech for Wise Money. Today's episode is Capital Stack Solutions, how Ahead CRE is navigating market disruption in commercial real estate. I'm Gary Wayne and I'm joined today by Laura Gonzales, founder and CEO of Ahead CRE. Laura helps developers finance deals across capital stack, debt, equity, preferred equity, across the southeast and nationwide. She spent over 20 years running commercial real estate departments at regional and national banks. Right now, the CRE market is facing some real headwinds: tariffs, rising construction costs, labour constraints, and a pullback in equity capital. So her expertise has never been more valuable. Today, we're talking about what Laura is seeing in the market, how the deals are getting done, and where this is all heading. Thanks for joining me today, Laura. Before we dive in, could we get a bit of background and context on how you got to where you are?
Absolutely. Thanks for having me, Gary.
It's lovely
Um,
to have you here.
so I went to college at Florida State University and got my undergraduate degree in finance and management and started out my real estate career at a company called Regency Realty, which became Regency Centers, a large shopping center REIT, and did that while I was getting my MBA, and really enjoyed the commercial real estate space. Was recruited into lending by one of my classmates in the MBA program, and as you mentioned, had a long career of 20 years working directly as a lender for the banks, starting out underwriting, ultimately managing an underwriting team, and then moved into the loan officer role and did multiple billions of dollars of commercial real estate lending, mostly in Florida, but for clients nationwide, and really fell in love with commercial real estate and being able to help with all of the different property types. And then in 2019, made the decision to make a career change and started this business, Ahead Consulting Solutions LLC, that goes by Ahead CRE. And we quickly was recruited into the brokerage companies given the client base that I had from the banking days. And so I joined Franklin Street and later Matthews to run their capital markets and market lead role, and got some great experience on the brokerage side where I was able to help find solutions for my clients that sometimes involved a bank and other times involved other sources of capital. And so it was a great experience for me. And then ultimately, I made the decision in October of 2023 to go out on my own. Have a team of three now, and we help clients from every type of company as well as a lot on the investor developer side, given my background, to place their financing of the full capital stack, which is a variety of debt and equity, as you mentioned. And so, given the headwinds that we've talked about, equity has been a larger component that's been needed to cover the limited debt options because of the debt service coverage ratios and the rising costs that you have described has made, filling the entire capital much more difficult today, and has given me a lot of great opportunities to help businesses be successful. And the biggest challenge is finding those equity dollars. And so that's what we're out there hunting for the different projects.
Well, you covered a lot in 20 years. I say you look too young to have done all that.
Yeah, I started when I was 5.
What exactly does a head CRE do, and why did you decide to focus on the full capital stack approach rather than specialising in just debt or just equity?
Sure. So, the initial intent was to do debt because that's what my background was. And so obviously that was natural to place that piece of it. But what I've found is that as the lenders have gotten more conservative in their underwriting, and what the interest rates as they rose was causing the projects to support a lesser amount of debt, there was just a growing need for the equity. And so some sponsors have the ability to put it all in themselves. Others already had some existing partners, but as you can imagine, as the challenges have been out in the market, a lot of the larger institutional groups have decided to stay only with their institutional clients. And so those smaller regional clients, had a gap in their ability to do projects. And if they put all of their own dollars in only one, um, it would likely limit them to only one deal that they can finance. So they have really needed some assistance to be able to help fulfill the entire capital stack as the projects have gotten more expensive and the debt percentages have gone down.
You mentioned you work primarily in the southeast, but handle deals nationwide. I think when we
Mhm.
last spoke, what's your sweet spot geographically and by deal
Sure.
size?
Honestly, we can do them anywhere. It's just, especially on the debt side, more of our relationships have been on the banking and that side, more in the Southeast with just the individuals that we know. But a lot of deals are funded with private money that's nationwide, and it does not matter where the sponsors are located. It's really just a matter of who we target for us calling on, but we do get referrals from all over the country and would be happy to assist a client if they reached out directly. We're just honing our, prospecting efforts on, more local or people that we're aware of that are out there. And we help with everything from land all the way through construction, renovation, acquisitions. And then we have partners that help us on the stabilized side that we can also do the life company and the agency execution. And, really it's just matching the best sources of capital to the specific deal. Is it development? Is it redevelopment? Is it in a major market? Is it in a, secondary or tertiary location? That really depends on, what lenders are going to be interested. And then obviously recourse, non-recourse. I mean, there's so many different factors. But what I love is that I'm able to do all the property types, and being that that's how things were done on the lending side for the 20 years of my career, it's given me the ability to always stay busy with variety of property types that are out there. As multifamily will be hot at some point, and then retail and industrial and office. And throughout your career, if you limit yourself to only one of those buckets, you could, be in a real lull when that segment of the market is negatively impacted. And so it's been great to be able to have the variety of property types to work on, as well as the variety of stages of the project and all the different sources to really match what's best for the deal and for that client.
Do you have a minimum ticket size or are you open for everybody?
Yes, we primarily start at a minimum of $1 million. But most, I would say, our average deals are much larger than that, tend to be in the 5 to $100 million overall. And on the equity side, it's typically $5 million check sizes and up. But there's really limited options out there if you're talking about less than the five for one partner that we're matching to. As we're not raising the equity ourselves, we're matching you to an equity group that typically writes the check for the full amount that's needed. And so, those groups are typically more of the family offices, the, hedge funds, the pensions, more of those types of players. And so, they have obviously minimum check sizes that they typically are looking to execute. And we are typically looking for those partners that really can grow with our clients and that they could do repeat deals with, either on the acquisition side or the development side. And we have a variety of clients that, of course, do both. But most of them out there focus in one segment or another. Multifamily has been a very common area that we've been helping on the equity, but we're starting to see a much greater need on both the retail and industrial. And on retail, it's typically larger grocer anchored shopping centers and, the credit appetites that a lot of lenders and equity groups enjoy being a part of. And again, it's because of those items you mentioned, with rising construction costs, with land costs, interest rate. It's just, causing the overall price of these projects to go up quite significantly.
Sounds really exciting, actually. I think I'd love to do the job you do. Where do you see the most opportunity at the moment?
So right now we're seeing the greatest demand for the industrial and the retail space, either credit tenants, grocery anchored shopping centers, single tenant on the retail side, and then definitely industrial is a hot, market right now, but we are still seeing great success in multifamily, and we're seeing people take advantage on the office side of some great deals that are out there, and that's projects that are located in great locations are really seeing some tick up in the occupancy as people are coming back into the office to work or just working in different ways. And then on the home builder side, we're seeing a lot of activity there where clients are needing to either fund for those A&D loans to get the lots ready for large home builders to take them down. We help with some of the high-end homes that are in the rental property, but everything for commercial uses. We don't play in the consumer side of residential, only on the commercial.
Sounds good. You covered a developer's entire financing journey from
Mhm.
acquisition through to stabilisation. Maybe you could walk me through what that looks like in practice. Give me a case study or something.
Sure. So, for example, we'll get a call when somebody is taking down the land to do, let's say it could be any type of development, but a good example of one recently is a multifamily development where they needed to acquire the land initially. And so we can help them with, either bank financing or private lender is typically the route that they want to go because they can get higher leverage on that land basis. And then ultimately, as they get all of their construction bids back and have a full sources and uses of funds that we can put together, then they'll, come to us to place the construction loan as well as equity if it's needed. A lot of clients have been looking for LP equity, which is limited partner dollars that are typically their preferences on a 90-10 split. So of the equity amount of the deal, they're looking for somebody that would come to the table with 90% of the equity dollars and they put in 10% as the general partner. And then there's typically a waterfall structure on the sharing of the profits throughout. If they go the preferred equity route, then they're paying a pref fee on those dollars instead of a split of the waterfall. And sometimes there's a combination of both approaches that are into the project. And we also have clients that are looking for co-GP dollars, which they would be, earning at the general partner level as well as a limited partner. And so they're able to stay in with a lot more control and sometimes provide a guarantee to help the funding get better terms. And then ultimately that helps them to share in those better profits on the back end because they're paying less of an interest rate. And then as that project stabilizes after the construction's complete and it's actually leased up, then we have the ability to refinance it with, like I mentioned, either a life company loan or if it's a multifamily project, then there's Fannie and Freddie agency loans that can be done. And those typically are done on a non-recourse basis where there's no longer a need for a guarantee and they get better interest rate and longer term. And so it allows them to either hold the property long term at a fixed interest rate that allows them to budget and to burn off that as guarantee requirements, or it gives them the ability to sell the property with the great financing opportunity that it can be an assumable loan. And so there's many times where we're involved in a project multiple times through its life cycle, and then we may ultimately finance the buyer of the property when we sell it and it continues on. And, many times clients are taking advantage of like 1031 exchanges to limit their taxation on a property. So we can help them with getting an intermediary that they need to work with, or, just financing the shortfall of whatever those 1031 dollars cover. And because we're a consulting company, there's many times where clients are coming to us to assist them with the due diligence, especially if they're not local and they don't know all of the partners. Or in addition to developers, we do help companies or nonprofits with their funding. And we find that they need us a lot more if it's a construction loan or those types of things, because that may not be their expertise. They're running a company and they need us to guide them to make sure that they're doing all of the things that are necessary to protect them, whether it be environmental, reports, appraisals, surveys, title, all of the different things that are necessary to make sure that they have clear access to the property and no risk from prior things that the property may have served.
Do you do the 1031s yourself?
No, we don't do them ourselves. That's something that requires an intermediary, but we have really good contacts out there that we help them. So the challenge with the 1031 exchange, of course, is that you have to identify the property quickly and have to make sure you don't miss the deadline for
Yeah.
those. And so for us, it's making sure that they've got the right partner matching them and that we're able to meet their deadline for the funding that needs to occur so that they can roll into the property that they're acquiring so that they don't have a taxation event. And we're seeing a lot more of those today. And because the timing of some of these projects takes longer, it's even more important that they engage us as soon as they've identified the property that they're going to acquire so that we can help make sure they hit the deadline.
When you talk about finance, what sort of loans of value can people get in the States for these type of projects?
Sure. If it's a stabilized property, then the options are still pretty high. They typically can get up to 75% leverage on a loan to value standpoint. If it's something that it's not stabilized, then that's where the limitations are. And most of the groups out there are focusing more on the loan to cost instead of the loan to value because they want to ensure that clients have skin in the game, that they've put actual cash into the project to make sure that it will support and that they won't walk away. The fear is always, someone turning the keys back into the property. And especially on the banking side, that is not what, bankers are looking for. They want to be repaid and they want to see that their interest payments are made. Sometimes on the private lending side, it's a different story. They may be making the loan in the hopes that the client does not perform and that they can ultimately own that asset. And so those are some of the risks that we have to make sure that a client understands that you definitely don't want to go into default or miss on a payment on a property that somebody really wants to own because they will move forward in the proceedings to be able to ultimately own that project. And so, we're trying to advise clients for giving them the best terms, but also making sure that they're not over leveraging properties where they won't have the ability to refinance them out with a permanent loan when they're finished. Short-term loans are great to acquire a property or to, get in there to be able to ultimately stabilize them. But you don't want to be in a situation where you've over levered it and you can't refinance it out because those are short-term loans that need to be paid off typically within 1 to 2 years.
In M&A in the States, you get a lot of vendor finance. Do you give that property at all?
I'm sorry, can you repeat that?
Vendor finance. So in the M&A, when
Hmm.
someone's selling a company, a lot of the time, the baby boomer or whoever it is, will actually say, well, our finance, I'll leave 30% of the value in, and you go and raise a loan for 70%, and then you
Yes,
can pay me back for 30% on completion,
correct.
or when you refinance.
Mhm.
Does that happen in property as well?
It does. So absolutely. And that's typically that equity partner role that somebody is putting in that they don't have a guarantee of getting their funds back. It's all based on the profit on the end. And so that's the difference with debt is actually securitized by the property with typically a mortgage or a deed, depending on the state. And they're structured in a way that they're protected through the courts in the event of something went wrong. Whereas when you're taking an equity position, unless it's mezz, it typically is, a shareholder loan basically where you're getting a piece of the ownership of the project, not necessarily a piece of the actual property because you don't have hard collateral that is secured. And so that's why those groups typically make a greater return as they're taking on the risk where they're not in a securitized position. But luckily, most of the projects that we've had the good fortune of working on have, ultimately been able to hit their parameters and make a nice profit for the equity partner as well as the sponsor that's doing the project. But yes, that is basically what has been forced to happen today is that there's had to be a lot more of those checks either from the sponsor or from one of their equity partners to put in to make these projects viable with the raising costs. the good news is what we've seen lately is we're starting to see it stabilize. We've had two interest rate cuts by the feds, which has obviously signaled that the rates are not going up. We've had a lot of the construction costs stabilizing. They're not necessarily going down, but they're not continuing to increase. And there's been some resolution on the tariffs, which has given people hope that, they can know what the cost of the goods are going to be. And obviously after COVID, it was just difficult to get goods. So furniture, appliances, lumber, whatever it was that was necessary to fulfill the project became extremely difficult to get. And so that was also impacting the timeline of how long it was taking to build the projects. And it's very important, especially if you're doing like a student housing project, that it needs to deliver on time so that you don't miss a school year. There's other things that may be impacted with the leases if you've got, a single tenant that needs to be in by a certain date, or you have, a grocery anchored shopping center. You obviously, it impacts all the other tenants if the main grocery store doesn't open. So there's very important deadlines in projects that are outside of even just the closing deadline, but other hurdles that need to be met to make sure that the overall project is a success. And so we try to help the clients through all of it. And once we've closed a deal, we're in it for the full time that the debt or equity is outstanding, to be able to help them through covenants and reporting, insurance, whatever the challenge may be. And being that I'm in Florida, insurance has been a real hurdle, especially for wind insurance, with the costs that has gone up, and just finding, viable sources for some of those things. But we've been very lucky this year from a hurricane standpoint, that, Florida was, so far so good. We're
Yeah,
technically past the hurricane
not
season, but
greater,
we know
thank
they could
God.
still happen.
You mentioned the market has become more challenging recently. What are the biggest headwinds that you're seeing right now?
I think the biggest headwinds is just the way that things are being underwritten today, because we had such a high growth plan for so long that the, rents were able to go up on a lot of the properties, that everybody kind of got spoiled, that there was plenty of growth. And so, the underwriting wasn't as stringent. As we've seen a drop in the growth of the rents and in other areas for both, all the different property types, a lot of the lenders and the equity groups are starting to look at different metrics like untrended rents, and they're wanting to see higher expenses put in, and just a more conservative look at the deal, and higher hurdles that they're wanting to see on IRR returns, return on costs, those types of things. And with the, negative things being pressured, it makes it more difficult to obtain some of those. So that's where I think has been the most difficulty, is finding the right match for those projects. Now, we all know that zero growth is unrealistic, and that if you're going to grow the expenses and not the income, ultimately the project's going to struggle. But, I think people need to be planning for a more normalized growth. And so, more of what we're seeing is the 3 to 5%. And, there for a while we were experiencing as much as 40% growth, which is not sustainable. And so that, I think, has been, the challenge for us, is to make sure that the deals can still pencil on that basis. And hopefully the growth does happen, and then the profitability will reflect that in actual basis. But they're wanting to make sure that in the event that doesn't occur, will the project still work? And a lot of that
You,
comes down to cap rates in the end. And that's, the biggest challenge is estimating what those will be when the project's finished, if it's a construction or one that needs a lease up or other items. But so far, we really have not seen a large jump in the cap rates. And I think with the interest rates, staying lower, that will likely continue. But there is a flight for quality. And so what we're seeing is quality assets, top locations really are getting a lot more competition on the sale as well as the financing of properties. And like I said, single tenant credit deals, will have unbelievable responses from the lenders on those. Grocery anchor shopping centers, industrial projects. I mean, there's just certain ones that you will have a lot of different groups being very aggressive to get those terms. And so sometimes you're seeing higher loan to cost, higher loan to values, better interest rates than what we even estimated because of that competition that putting it out to bid delivers. And I think that's something that a lot of times clients are fearful of paying a broker fee. But when a broker comes to a lender, they automatically know it's being competed for and they tend to sharpen their pencil and give a better deal than what they would direct.
You must have a lot of numbers going around your head.
Oh, yes.
There's a lot to think of. You mentioned tariffs and construction costs earlier. I mean, have they made a huge impact in your clients' deals? And has it affected a lot of feasibility studies?
Absolutely. When it first happened was obviously the largest impact because it was with so many different locations. And so, if it's only with one area, it's easy to just find another location to potentially purchase goods from. But when they first happened, obviously it impacted a lot of different areas that clients typically got their goods in from. Appliances, electrical grids, I mean, those types of things really impacted projects because if you didn't have them, you could not start a project. Many times they would have a portion of what was needed, but they were missing, the chips that needed to go into, a washer and dryer, for example, or a refrigerator that is, you can't implement them if they're not able to, to work.
Sure.
And so those things made it challenging. We have seen that has stabilized more, and most lenders and equity groups require what's called a GMP contract, which is a guaranteed maximum price. And that made it really difficult for the contractors because they had to build in some additional costs to the contract to protect themselves against additional costs that they were going to have to pay with the tariffs or with just getting goods and services in. And so that made the overall project higher. And so what we've seen is, they're able to better estimate the true cost of the goods and not have to add in so much of those contingencies. Pretty much all lenders and equity groups still require a contingency to be added to the project, which is typically around 4 to 5%. But that's much better than when we were adding 15, 20% because of potential tariffs or other things. So that's really helped a lot with, like I said, it's not necessarily the prices are coming down, but it's just more of a stabilization of the costs that are making these projects more viable. And since the second Fed cut, we've gotten more calls of people ready to actually move forward with their projects than we had the rest of the year. So we're already seeing the impact of, the interest rate drops and the tariffs impact on all of this. And then the other piece we haven't talked about is labor. There has been some impact with labor as well, and some of that has to do with the immigration changes that have happened, and some of it just has to do with when there's a lot of projects getting built at one time, there's just limited subcontractors available to bid on the jobs, and so that can also increase the cost. And so that's where having the right general contractor that has those great sub relationships and can, have repeat jobs for them to work on tends to keep the prices down for a lot of the clients and who they choose. Because if you're having to go out and hire a different group in every city,
Sure.
that may be challenging.
Is labour costs going up or
Yes.
flatlining?
Labor
Going
costs
up.
is definitely going up, and the amount of individuals doing some of the pieces of the job has gone down because of immigration
So,
rules.
so obviously Trump's plans on immigration are actually pushing labour costs up.
And they will in the short run, yes, unless we have more people that start doing trades. And that's something that we've been struggling with for a while is that we need more people coming out of high school to enter the trades and have good labor sources here. But there's always going to be certain parts of the job that are not highly demanded to do the work of the lower cost, sometimes roofing, drywall, some of those other areas tend to be, less US citizens wanting to fulfill those
Yeah,
roles.
locals don't seem to want to do those jobs anymore, do they?
Correct.
Even in
And
the
just
UK, it's the same.
minimum wages have gone up, cost of benefits to, cover employees. I mean, just in general, um, it's more expensive to hire good teams.
Well, we talked about Trump and tariffs, and you said you saw positives and negatives. What's your general thinking on that, and how it's going to affect the commercial real estate market in 12 to 24 months? Do we think we're stabilising, or do you think we're going to have more aggravation? Do we see more volatility coming? And how do you cope with that?
I do think that we're stabilizing more. I do think that we're getting a better idea of what those ultimate costs are and that people can at least plan for it to be what it is today and not have to keep assuming further increases. But again, a lot of it comes down to the economies of the overall project. Where I'm seeing the best success is people who already own the land or have owned it for a long time. If they're doing a development project, obviously that makes the numbers work a lot better when the price point was based on a previous point in time, or if they have a great relationship with a general contractor that they're getting, some sort of better terms. And so it really comes down to expertise and knowing your market and what kind of deals that you're able to negotiate. There's obviously a lot of off-market purchasing still happening, which, tends to make people believe that they're getting a better deal than when it's bid up for, like I said, those quality assets where people just keep, writing a check a little bit higher when they're negotiating on that. So we definitely are seeing, some of that. But yes, I mean, everyone is having to be realistic with any of the things that are out there that something could change. But the interest rates, I don't think most people think they're going to continue to fall like they were at the lowest point, but they're able to see a light at the end of the tunnel that they're not going up. And similarly with just inflation in general and a lot of the costs of goods that are needing to come in, we are starting to see more people wanting to, manufacture in the US, which is what the ultimate goal was of the tariffs, is to bring some of that home. I'm actually working with a client right now that is looking to expand and relocate their manufacturing facility to Florida, and we're seeing a lot of that in certain areas that have been very pro-business, that, there's been an increase of companies coming into the US to do that. And, the biggest challenge previous to that was, again, the back to that labor conversation that we had, that just what we need to pay in the United States and the benefits provided are much higher than what it was in other countries like China, for example. You were seeing a lot of the manufacturing move to those areas and they're starting to come back, but it'll take a long time.
Yeah, well, I mean, are they closing down factories abroad to bring them back here?
hmm So they're starting to see a lot more of that, but again, that is not an overnight situation. I mean, even the one I'm helping right now that's relocating from another part of the country, it's not a quick overnight process. But they do provide a good that is needed in the commercial real estate construction industry. And so their orders have greatly increased, which is requiring them to take on another production line. And so we are starting to see that if it's produced here, there is people that are wanting to purchase it, and it speeds up their access to the good, as well as knowing for sure that they'll be able to acquire them, and that's, where we're seeing some of the impact. And
In
yeah.
oh, sorry, go on.
Mhm.
In your industry, in the CRE industry, do you see a lot of automation technology? Are you seeing changes in the way people do their day-to-day functions?
Absolutely, AI has become something that we're interacting with every single day. I think all of us have gotten into the habit of chat GPTing different things to find out the answer, and it's been good and bad. We find that a lot of clients, feel that they can solve some of their problems with, a search like that. But number one, there's a lot of security risks with AI, and that companies need to be extremely careful with sharing their confidential information out there for other people to be able to research. But also, there's a lot of things that go into a project more than just what can be spit out on the computer. Yeah, they may be able to give you numbers or returns, but they're not going to, think about the human interaction and whether or not that price point equates to the right person being your advisor or the right group that's protecting you. But we at Ahead CRE use AI a lot to help track down the lenders. As we all know, they change a lot over the years as to which institutions they're at. And so being able to use AI to make sure that we're current on where someone works, what their current email, phone number is, being able to find additional equity partners. I mean, we love the benefits that come with it. I think we all just need to be cautious of the security risks and some of the cracks in the system that we don't really know what all of that entails yet. So we're trying to stay up to speed on it and use vendors that have the solutions for it when it makes sense. But at the same time, it's only as good as the information that gets put in.
Of
So,
course.
as with everything out there.
What about processes and marketing and scaling? How do you go about that?
Absolutely. So we've purchased some tools that help with all of that, as well as, we don't believe in mass sending out packages. We very much target it to who we want it to go to. And that's where our CRM system that, we're able to track both the debt and the equity and type in what type of project it is, what part of the country is it located in, what's the size, and try to make sure that we know who we're sending it to and that we're constantly keeping up with what the appetite is so that someone's not getting hit with 50 packages that are not a fit to their box. And so, that's always challenging to keep up with, but we really try to attempt to understand what their target is that they want. And that speeds up our ability to deliver a solution to the client, but also to keep our equity and lenders happy that they're getting the right matches for what it is that they're active in lending on.
If you could implement one piece of technology or automation to make things better for you, what would it be if it was out there?
Yeah, definitely on the equity side. That's been the biggest challenge. There's a lot of solutions for the debt. Finding the equity partners is sometimes the most challenging because they don't typically advertise, they don't put themselves out on websites and LinkedIn for you to find. They typically want to only be known to those that they want to work with. And so I know for us specifically, that is always the most necessary is to know the right contacts and what type of projects that an equity group would be interested in funding because we have a lot of clients that have deals that they're just waiting on that equity to be able to proceed forward. And so we need to know who's got capital that they can invest in a project and know what type of deal that they would be looking for and their parameters. And so if I could find an AI tool that would solve for that, we would be very motivated. Or just getting the equity groups to reach out and say, hey, we've got some money to invest. We need to know, do you have these type of assets or these types of clients so that we can match them together?
I'm sure we can help you. What what's your competitive advantage in the market compared to your competitors?
Sure. So I would say the biggest one is that we don't only do one property type, and so we're able to help clients with all of their projects. And it's really the full service that we offer. It's not just matching, it's helping them through the process. We don't replace attorneys or CPAs or anything like that, but being able to really solve for the business issues that no one tends to focus on, making sure their covenants are set up correctly, that their budgets have been done, that they've accounted for every dollar of equity that they've already invested in their property, that they're protecting themselves with getting the right type of due diligence done so that they're not taking on an asset that'll drop in value later. And it's really just connecting. We do a really good job of matching our clients up with other clients that could be partners or connecting them to the right general contractors or the right survey companies or environmental, you name it. A lot of what we do is match them and then we get involved if there's a problem. We had one recently where we just could not get certain approvals done we were able to find the solution for who could step in to help get that approval done so that they could make the deadline. It's really just being that advocate and advisor to the client and helping them through the process. The closings on a lot of these are much more intensive than they ever were before, with the items that the lenders or and equity groups are requiring to be able to get it across the finish line. We help do all of that, but of course the client reviews every item to make sure that it's accurate before it's submitted. But just anything that we can do to take on helping the process go smoother and faster and be done right the first time.
How do you charge on these sort of deals?
Yeah, so like I said, we're a consulting company, so many
Yeah.
times it's a consulting fee, and there's a variety of ways that can be done on a retainer agreement or an hourly basis. And then on the debt side, obviously, it's a success fee that we charge on a percentage of the debt, and we're only paid if we obviously get them to the closing table. We don't want our time wasted. We do primarily exclusive agreements so that our lenders and equity groups know that we actually have a client that wants to proceed so that their time is not being wasted either. But we're not charging high fees up front. It's truly we're paid at the closing with performance.
Is it a competitive business?
It's very competitive business, but there's limited people that play in the space that we play in. And because we do development and other more challenging, we do affordable, we do bond deals, we do some of the other things that a lot of people just don't have the expertise in. And a lot of that is just from my banking background, that these were projects that I had the opportunity to be exposed to. And we're always looking to learn. We even help with like bridging city incentives that come in with private public partnerships. I mean, we really try to figure out ways and sometimes to help with grant dollars that may be out there that a client can go after to fill in the capital stack. We're really trying to just be the advisor to help them through the process. And we're looking at it from a long-term relationship standpoint, not just one deal. And if it's something that we are not a fit for, we're not afraid to tell the client that this is not our best expertise. And many times we can match them to someone who is. I had a residential referral the other day that technically was a commercial property, but my lender sources were just not the right fit. And so I was able to go find someone that was and make the client happy that way. And ultimately, I'll get referrals from the person I referred it to, and I'll be able to refer to them again in the future. And so part of it is knowing what you're good at and what you're not.
Are you able to help clients issue bonds to raise capital?
We don't help issue the bonds, but we
Right.
do help them through the bond financing process. So we've done, like I said, a lot of affordable on the LIHTC, low income housing tax credit. We've done new market tax credits. They're a form of equity, but just a different form than the traditional that's out there. We've been able to help with, a lot of those types of transactions, but we're matching them again to somebody who provides the bond dollars similar to the equity. We're not raising it ourselves or closing it. And we've
Yeah.
got very good counsel that we work with to help make sure that those, are done properly. And, many groups, depending on how they're structured, have to get specific bid processes to do things. And we make sure that they're, adhering to whatever the rules that they're governed by, depending on the type of company that it is.
Interesting. Where do you see commercial financing going in the next 3 to 5 years?
Yeah, I think that there's going to be a lot of solutions out there online that a lot of people are going to attempt to use. And I think that for simple transactions, that may work well. But I'm fearful that there'll be some misses and not getting the true advisory that's needed for it. I think that it's going to continue to be, an area that people are going to need assistance to make it happen, because there's still going to be some conservative rules put in place to make it happen. And I think there's going to be good client demand for an alternative source of investment. When we're typically are talking to investors, they're comparing what they could get in the stock market or what they could get in crypto versus what they'll get in real estate. And a lot of the clients out there love that it's a hard asset that they actually can hold on to. And, if the timing's not right in the market, the good news is you don't have to sell it. You could hold on to it for a longer period of time. And, sometimes that may mean that you have to replace your equity partners because they want out. But there are solutions to that. And so I think that it's going to still be, challenging, but projects are going to be getting done. And that's what's exciting to see. And we just need to make sure that they're structured right in the best way for the client to ultimately get what they're hoping out of it. If it's a long-term hold for family generations, or is it a short-term play to sell it and take the dollars and put it into another asset?
What's the one thing about your industry or market most people get completely wrong?
I think it's the understanding of all of the alphabet soup. We talk with a lot of terms that I think people think they know what the meaning of and don't always understand. And I think that's with every industry, but it's really important that you have somebody who is able to walk you through the process. We talked about it earlier, loan to cost, loan to value. A lot of people get really confused with that, and it's typically always the lesser of. And so that's something that they're thinking, oh, I can get as much as 75% loan to value. Well, not necessarily if you're, limited on the other side, or just not really understanding the importance of the location of the site. I mean, we can talk about financing all day long, but it really typically comes down to the asset. If you've got an industrial project that doesn't have a light for the trucks to turn in, even if they're sitting there for 5 to 10 minutes, um, imagine every truck doing that all day long and not able to turn properly into the project, or having it be in an area where they can't get their customers in if it's on the retail side, or, in a market that's, not expanding with employers, then you may not have the same demand for housing. And, so I think the asset's the most important part. And then we help get the financing to work with it. But I think clients need to really make sure that what are they buying and understanding a little more about the project, because we're obviously going to have to spin that story to the lenders and the equity groups as to why they should invest in doing that project and why it will be worth more in the future than what it is today.
If you could wave a magic wand and fix one thing in the CRE financing landscape, what would it be?
It would probably be to get buyers and sellers to be on the same page. Boy, have we had some challenges with that recently. It seems like every property that we look at that is for sale, that the seller is trying to sell it based on what it will be worth instead of what it's worth today. And so that makes it very challenging with the current financing rules that are put in place, that unless you're getting a loan done on a pro forma basis, you're typically getting it done as to what the performance is right now. There is a wide gap between what the project typically supports today and what the seller thinks that it should be worth. And so that's just making more of a challenge for the deals to close, and we want to see more closings occur. And there just seems to be a big gap still in what people think an asset is worth today.
I think we see that in everything, don't we? M&A especially. People selling their businesses think they're worth fortunes, but
Hmm.
the real value is nothing like it. So so nothing gets sold. What's
Correct.
your advice to developers who are trying to navigate the market right now? What's the one thing they should be focusing on?
Absolutely. I mean, they should be realistic about the true, structure of what do they think the property has today, what is it, got for the future, and really just making sure that they're realistic with those expectations. I see a lot of people that, are excited about what it could be and need to make sure that that's great if it gets to that point, but they really need to be making a lot more decisions on where the project is performing today and making sure that they're truly looking at the comparables, comps that are out there for if they're developing something. Because if they're, I mean, of course, it's going to probably rent for a little bit more because it's new. Um, but in today's market, that doesn't always equate. So just, I would say, being a little more conservative with their analysis, and then if they're correct, wonderful. You'll have a much higher profit. You'll have a much higher debt service coverage. All of your parameters will look fantastic. You'll deliver a much higher IRR. But if you set yourself up for failure and you don't hit those hurdles, you're not going to have a partner wanting to work with you again in the future. You're not going to have a lender that wants to take that risk. And so it's really just understanding that you've got to be realistic and you've got to hire the right partners. And so, not only someone like us that helps, but all the other pieces of that project, having a consultant that's really looking out for your best interest and not just the cheapest or the fastest or the one that tells you the number that you want, but it's going to tell you the truth and tell you if they see a risk that needs to be done. And then also roofs. Oh my goodness, like that is impacting so many of our projects getting done. And so making sure if you're buying an existing asset that you're double checking what the true life of that's going to be, because most of the insurance companies are no longer giving you the benefit of the years that we used to hope that our roofs would last. And so that's on residential and commercial for sure.
So they certainly need your services.
So we would
So
love to be able to help clients that are out there with, evaluating and let them know if it's something that we could assist them with, and would love to be able to talk to any equity groups that have money that they'd like to invest.
So with that said, where can our listeners find you if they want your services?
Sure. Well, our website is aheadcre.com, aheadcre.com. I can be reached at Laura at aheadcre.com for my email. And the rest of the contact information is on the website.
It's fantastic. Well, I think it's been a really good podcast. I want to thank you for attending, and I'd like to thank our listeners for listening in. I'm Gary Wayne from A1 Solutions. You can find me on LinkedIn or on my website, www.a1solutionsinternational.com. Thank you everybody for listening. Laura, thank you again for being a great guest. You're very, very knowledgeable, and I'm sure you're going to do very well. Thank you.
Thank you, Gary.